Hey folks, about a week ago we sent out a research note that discussed why we are getting somewhat cautious in the short term and why we think hedging the portfolio a little bit, depending on where you allocate it, does make a lot of sense. And so I wanted to elaborate on this a little bit more, give you a couple more charts, and give a couple ideas that you could go about using to hedge yourself or even to play the downside should there be some sort of a corrective period in the short term. And I should say, before I even look at bring over the first chart, we do remain quite constructive. If you look at particularly, given the reopening trade, we continue to think we're coming out of a fairly unprecedented period, almost like a post-war-like period. So we do think there's more upside, but I think it's more in individual pockets of stocks, not just the broad indices. The S&P 500, as I'm recording this right now, is up around 11 or 12% or so year to date here in early May 2021. So of course this will be different depending on when you watch this. But let's move over to the first chart. And this is a simple chart looking at the S&P 500. And what I did here is a couple things. First of all, it's a long-term chart. If you look at it, you can see it stretches back all the way to the beginning of this major bull market we've had over the past, call it 11 or 12 years or so. And it's also a monthly chart. And by that we mean that each one of the bars you see, each one of the candlesticks is 1 month worth of price action. So that's one thing. The second thing that's arguably more important is that I made this what's called a logarithmic chart. And you can look up what that means, but basically it just means you kind of smoothen things out a bit to give you sort of a less sort of volatile chart. It basically gives more weight to the more recent price action, make things smoother. So long story short, you can see on this long-term logarithmic chart, and basically most long-term charts, I'm a big fan of making them logarithmic. You can see we've reached the very upper end of that channel. Doesn't mean we can't go higher, but it's something to keep in mind. And you can see for the past 12 years, every time we got up towards that upper end of the range, we did kind of pause to some extent. That's chart number one. The other chart, and it really goes nicely hand in hand with this chart that I just showed you, is that if you look at this statistic I just came across the other day, right now, basically more stocks than ever are trading above the 200-day moving average. So again, that does not mean that the stock market has to fall apart, but it does indicate to me that I think on an index level, and again I have to make this clear, that's on an index level in the S&P 500, which a lot of people are benchmarked against, and the correlation of most people's portfolios is very high to that index. We are probably getting quite stretched. So I would imagine it wouldn't be too difficult to get a 5 to 10% pullback, which doesn't sound like a lot, and really it isn't in greater things. But what it does do is it does mess with people's emotions. So it's probably better to be hedged a little bit, take some positions off. So a couple easy way of doing this is very simply, and I'll just go back to the S&P 500 chart. One could simply just book some profits. If you're long stocks, particularly ones that are highly correlated to the S&P 500, just clip some of those if you're sitting on profits. Another way is just basically short the S&P 500. You can do that with an SPY ETF to short some of that. And then, of course, you can use, one of dozens and dozens of option strategies. And I would keep it simple. Just buying some puts or put spreads at the money, which just means to the current level of the S&P 500. Using options expiring at some point, maybe in July, keep them on for a couple of weeks and see what happens. Don't hold them all the way through expiration. That's a very losing strategy over time. But just kind of hedge yourself a little bit that way. I'll show you another chart, and that's just because it goes hand in hand with this chart here. And this, what I'm bringing up now is an individual stock. And the stock we're looking at here is UPS. And what I did here is very much the same thing I just showed you on the previous chart of the S&P 500. I made this what's called a logarithmic chart, again looking back basically to the beginning of the bull market in 2009. And you can see that UPS, not only is it morbidly overbought by almost every metric in terms of momentum, it's also reaching the upper end of that long-term sort of uptrend for the past 12 years. Again, this is a logarithmic chart. So what we're seeing here is probably an opportunity as good as I've ever seen to reduce some risk if you're long, put on some hedges selectively, whether that's as a hedge or again opportunistically, meaning you want to actually make money from the downside. Keep it simple, buy some at-the-money puts. What I probably wouldn't do is buy an inverse ETF, and I'm sure if you guys have any questions or comments on that, I'm happy to make a separate video on that. Just leave a comment down below. We will, depending on how much feedback there's in that, inverse ETFs, and there's a place for them, but it's not to be invested in. It's really a very quick trade. It makes sense for anything more than a few days. I think they're quite dangerous and just don't make a lot of sense. But anyway, folks, I hope this was helpful, and we'll see you guys in the next video. Thanks for watching.